Have you ever, stopped to think about the paint on your walls or maybe the coating on your car and just wondered about the massive industry behind it all?
It's huge, isn't it?
Exactly. So today we're doing a deep dive into the Sherwin-Williams Company, tickers SHW.
Right.
Our goal here is to look, way beyond just the surface coat. We've pulled together a stack of sources, business analyses, financial reports, you name it.
All the good stuff.
Yeah, to really get under the hood of what makes this company tick. I mean, founded way back in 1866, how have they built such an enduring global business?
That's the core question, isn't it? We're not just going to list what they do.
Right.
We want to explore why their approach, their specific way of doing things, has built such a durable company. We'll look at what makes up their competitive fortress, as some analysts call it,
right,
and how they manage all their resources to stay on top.
All right, let's get into it. Let's unpack this business model. Sherwin-Williams, global leader, manufacturing, development, distribution, sales, paints, coatings, all that related stuff. But how does that actually work day to day?
Well, they've structured things really smartly. It's basically 3 distinct segments, but they're deeply connected. They really cover almost every corner of the coatings market.
Okay, segment 1.
First up is the big one, the Paint Stores Group, or PSG. This is their powerhouse, largest division, most profitable. It brought in, about 55.4% of total revenue?
Wow.
Yeah, like $13.19 billion in 2024. And this is all built around their network of over 5,000 company-owned stores, primarily across the Americas.
Company-owned, okay. And who shops there, mostly?
Their main customer, their bread and butter, is the professional painting contractor.
The pros.
Exactly. They do serve the DIY folks, too, people like us painting a room on the weekend. But that's really a secondary focus for the PSG stores.
Got it. What's the next piece?
Next is the Consumer Brands Group, CBG. That did about $3.22 billion in external sales in 2024.
It's external.
Yeah. And this is where you see those familiar brands like Valspar, Minwax, Thompson's Water Seal, stuff you find big retailers like Lowe's.
Right, the DIY aisle.
Precisely, targeting the DIY customer. But here's the really crucial part about CBG. It's not just selling those cans. It's actually the strategic hub managing their global supply chain. A huge chunk of its sales, like 63% in 2024, were actually inter-segment transfers.
So they're supplying the Paint Stores Group.
Exactly. They make sure those pro stores have the inventory they need. It's this kind of quiet integration that gives them a lot of power.
Interesting. Okay, and the third segment?
That's the Performance Coatings Group, PCG. Pulled in about $7.5 billion in net sales in 2024. This group is all about highly engineered, specialized industrial coatings.
Industrial stuff, like what?
Think coatings for heavy machinery, packaging, cars, trucks, even bridges. They serve diverse markets in over 120 countries. Sales here are often direct, big custom orders. And PCG is also where a lot of their advanced R&D happens.
Okay, so you've got the pro stores, the DIY brands feeding the stores and selling retail, and then the heavy industrial coatings. When you boil it all down, what's the core business model here? It sounds simple, almost.
It kind of is at its heart, and that's its strength. They sell products that protect and beautify physical assets.
Right. Walls need paint, cars need coats.
Exactly. Buildings, infrastructure, equipment, these things need protection. They need maintenance. It's a fundamental need, not really discretionary. So there's always demand.
And that demand seems pretty steady or even growing.
Yeah, and that's boosted by this really powerful long-term trend. The shift away from do-it-yourself DIY towards do-it-for-me DIFM.
People hiring painters instead of doing it themselves.
Precisely. The numbers are pretty stark. Back in, say, 1980, almost 60% of paint bought in the U.S. was for DIY projects.
Wow, most of it.
Yeah. But by 2023, it completely flipped. Professionals accounted for 63% of the volume.
That's a huge shift.
It is, and that directly plays into the hands of Sherwin-Williams' most profitable segment, the Paint Stores Group, because the pros are their main customers there.
Okay, so that lays out the business, but what really sets them apart? You mentioned this competitive fortress. Are we talking about a classic economic moat?
We absolutely are. It's not just about selling paint. They've built this incredibly strong, sustainable advantage. It comes from 2 main things: powerful, intangible assets and a really significant cost advantage.
All right, let's dig into the intangibles first. What are we talking about there?
Primarily the Sherwin-Williams brand. For professional painters especially, that name stands for quality, reliability, service.
Why is that so critical for a pro? Isn't paint just paint?
Not at all. Not for them. Think about it. A contractor's biggest cost isn't the paint can, it's their labor.
Right, paying the crew.
Exactly.
Yeah.
So if the paint fails or the color matches off, that means costly rework. It eats into their profit and, maybe worse, damages their reputation with their client.
Makes sense. So they need paint they can trust.
Totally. They need consistent products, spot-on color matching, and good advice from the store staff to get the job done right the first time. Sherwin-Williams has built that trust over, 150 years.
And that trust means they stick with the brand.
Huge loyalty. And that loyalty gives Sherwin-Williams pricing power. They don't have to be the cheapest. I mean, look at this. They have exclusive supply deals with 23 of the top 25 U.S. home builders.
23 out of 25. That says a lot.
It really does. That's the power of the intangible brand asset.
Okay, so brand trust is like the foundation. What about the walls of this fortress? You mentioned a cost advantage. Is that the store network?
That's exactly it. Their distribution network gives them a massive cost advantage. Over 5,000 company-operated stores. You mentioned it earlier. That's more than 6 times bigger than PPG, their closest rival.
6 times. That's dominance.
It is. And that density is key. For a contractor, time is money. Having a Sherwin-Williams store just a short drive away from pretty much any job site in North America minimizes downtime. They can quickly grab what they need and get back to work.
And these aren't just retail outlets, right? There's more behind them.
Oh, yeah. This network is the final piece of a fully vertically integrated system. Sherwin-Williams controls basically the whole chain, from R&D, developing the paint formulas, to manufacturing it in their own plants, and even delivering it with their own dedicated fleet of trucks, over 3,300 of them.
Wow, they own the trucks too.
Yep. That level of control over quality, over inventory, over costs, it's a huge structural advantage. You couldn't just replicate that overnight. It would take billions of dollars and years, probably decades.
We saw that advantage play out during the supply chain mess a few years ago, right? 2020, 2021, 2022.
Oh, absolutely. That was like a real-world stress test for the Moat.
How so?
Well, while lots of competitors were struggling to get raw materials, dealing with shipping nightmares, Sherwin-Williams, because they controlled so much of their own supply chain internally, they could keep making paint and keep their store shelves stocked.
And so when others were out, they had product.
Exactly. They became the reliable supplier. They kept their existing pro customers happy and working, and they actually won a lot of new business from competitors whose customers were just frustrated.
So they actually benefited from the disruption, in a way.
In a market share sense, yes. It showed how their structure lets them play offense when things get tough for everyone else. It's a direct result of that integrated model.
So this moat isn't just sitting there. It sounds like it's actively getting wider.
That's a really important point. Yes, it's absolutely a widening moat. And a key reason is their strategy of countercyclical investment.
Countercyclical, meaning they invest when times are bad.
Precisely. When the economy slows down, when housing starts to dip, competitors often pull back. They cut costs, maybe close stores, lay off salespeople.
Standard playbook for many companies.
Right. But Sherwin-Williams does the opposite. They use their financial strength to lean in. They keep opening new stores. They add sales territories. For example, even in 2024, which was, a challenging macro environment, they opened a net 79 new paint stores and added 100 new sales territories. They press their advantage when others are weak.
And that strengthens their position long term.
Absolutely. It reinforces that distribution advantage, grabs more market share. They've got a dominant 16.3% share in architectural coatings now. It creates this virtuous cycle.
How so?
The dense network attracts more pros, their loyalty generates high margin profits, and those profits fund more investment, especially during downturns, which further widens the gap. The moat gets deeper and wider.
Okay, fascinating stuff on the structure in the moat. But let's shift perspectives a bit. What about the view from the ground? What's the scuttlebutt? What do actual customers and employees say? Sounds like there's a bit of a split on the customer side.
Yeah, there definitely is a dichotomy. If you look at their core professional customer, the feedback is overwhelmingly positive. You hear terms like customer love, even.
Really?
Yeah. Pros consistently praise the knowledgeable staff in the stores, the quality, especially of the higher-end lines like Emerald or Duration, saying they cover well, they last.
Things that matter for their reputation.
Exactly. And they value the service's quick turnaround, accurate color matching. I saw an anecdote from one painter who said Sherwin-Williams was the only brand he'd use, claimed a paint job still looked great after a decade. That kind of loyalty is gold.
Okay, so the pros are happy. What about the rest of us, the DIYers?
That's where it gets more mixed. If you look online, you'll find complaints. But digging into them, a lot seem to stem from, well, user error.
Like what?
Like people not prepping surfaces properly before painting or expecting a cheap paint and primer in one to work miracles it wasn't designed for.
The classic blame the tools situation.
Kind of. There was even a revealing Reddit thread, supposedly by an employee, basically saying most bad reviews come from people just not following the instructions on the can. You also see some complaints about service at the big box stores where their consumer brands are sold, which is maybe less consistent than their own stores.
So the DIY complaints, while maybe valid for that customer, don't really threaten the core pro business.
It doesn't seem like it. The pros know how to use the products. They value the service at the dedicated stores. The DIY channel brings in revenue, sure, but the heart of the moat is that pro relationship.
That makes sense.
Okay.
What about the people working there? The employees behind the counter, the sales reps, they're the face of the company for those pros.
Right. And the employee perspective seems to be another strength. They have a very strong promote from within culture.
Oh, interesting.
Yeah. Anchored by this well-regarded management trainee program, lots of people start there and build a career. It leads to really impressive tenure. Get this. Around 7,000 employees have been with the company for over 20 years.
7,000. With 20 plus years, that's incredible in retail.
It really is. And the voluntary turnover for store managers and sales reps is super low, under 10%. The average for U.S. retail is something like 60%.
Wow. So people stick around. Why does that matter competitively?
Because that stability means experience. When a pro walks into a store, chances are they're talking to someone who really knows their stuff, who's seen it all, who can give them quick, valuable advice. That expertise builds relationships and creates high switching costs for the customer.
Harder to leave if the service is that good.
Exactly. Now, are there criticisms? Sure. You hear things like stores being understaffed sometimes, or the usual big company bureaucracy, but those seem pretty typical for any large organization and don't seem to break that core value proposition.
Okay, so a strong internal culture feeding into that pro relationship. This kind of enduring quality doesn't just happen, though. It points to leadership, right? Disciplined leadership. Heidi Petz took over as CEO recently, Jan 1st, 2024, an internal hire.
Right, an internal successor, which often signals continuity. And her approach seems very much aligned with that long-term disciplined philosophy that's worked for them.
What's her focus?
She talks about this operating philosophy called success by design. Key pillars seem to be focusing on customer success, which she calls alignment and speed in execution, and really importantly, playing offense aggressively.
There's that countercyclical idea again.
Exactly. Investing during uncertainty. Her language is very team-oriented, very forward-looking. It sounds like she's continuing that rational, long-term playbook.
And how does that translate into managing the company's money?
Yeah.
How do they handle capital allocation?
Their track record there is really clear and disciplined. They have a consistent hierarchy for what they do with the cash they generate.
Okay, number one priority.
Reinvestment back into the core business, growing the fortress. So in 2024, they spent about $1.1 billion on capital expenditures. That's for new stores, adding sales reps, finishing their big new HQ and R&D center in Cleveland, plus R&D spending itself, around $194 million in 2023.
Investing in the future. What's next?
Second is strategic acquisitions. They're not constantly buying companies, but when they do, it tends to be significant. The big one was Valspar back in 2017, $11.3 billion.
Huge deal. What was the thinking there?
It was transformational. It gave them true global scale, expanded their reach significantly in Asia Pacific and Europe, Middle East, Africa, and it added complementary strengths, especially in industrial and packaging coatings.
And did it work out financially? Integrating big acquisitions can be tough.
It seems to have worked very well. One analysis, adjusting for accounting differences, showed their underlying return on assets actually went up after the deal, from around 17% in 2016 to nearly 29% by 2020. So yeah, successful integration, real value created.
Impressive. Okay, so reinvestment, strategic M&A. What happens with the cash that's left over?
That goes back to the owners. Shareholder returns. They return all the excess cash through dividends and share buybacks.
How much are we talking?
A lot. In 2024, it was $2.46 billion returned to shareholders. The year before, $2.1 billion. And they have an incredible dividend track record.
Dividend aristocrat status.
Yeah, they've increased their dividend for over 45 consecutive years. That takes serious consistency and discipline.
It really paints a picture of a financial fortress, like you said.
Yeah.
Are there any chinks in the armor, though? Or are the financials just rock solid?
Look, no company is perfect. They face challenges like managing raw material costs, the complexity of a huge global operation, but those seem like things they manage well within their structure. Fundamentally, the financials are incredibly strong. This company is just a remarkably consistent earnings machine.
14 straight years of sales increases, I saw.
Through 2024, yeah. And it's not just sales growth. They protect and even expand their profitability, even when costs are rising everywhere. Like in 2024, with all the inflation talk, their gross margin actually went up by 1.8 percentage points to 48.5%.
That's impressive pricing power and efficiency.
It is. And the key ratios confirm this story.
Like ROIC, return on invested capital.
Exactly. It's consistently in the high teens, 18.8% in 2024. That's way above their estimated cost of capital, which is maybe around 11.7%. So they're creating significant economic value year after year.
And they generate actual cash, too.
Oh, yeah. Their free cash flow conversion is really strong. They're great at turning accounting profit into cash in the bank, often over 100% of net income. Even in 2024, with those big investments in the new HQ, it was still a healthy 77.6%.
Solid. And the balance sheet? Debt levels.
Very manageable. Balance sheet strength is there. Their net debt to EBITDA ratio is about 2.2 times at the end of 24. That gives them a big safety margin, lots of financial flexibility.
Okay, so quality business, strong moat, great management, solid financials. The million-dollar question then, what about the price? Are you paying up for all that quality? Is the stock expensive?
Yeah, that's the rub, isn't it? It definitely commands a premium valuation. As of, say, mid-2025, the PE ratio is around 33.4 times trailing earnings.
Which is high. Low. Average.
Yeah. It's pretty much in line with its recent 5-year average, but definitely a premium compared to its 10-year history. And price to free cash flow looks even higher, around 41 times, but that's partly skewed by those big one-off capital projects recently.
So not exactly a bargain bin stock.
Definitely not cheap by traditional metrics. But, for a business of this quality, this consistency, you could argue it's maybe a fair entry point for someone thinking long-term.
Why fair?
Because the market recognizes that durable moat, that predictable earnings stream. And a company that can reinvest capital and earn nearly 19% returns on it year after year, that kind of compounding power can let it grow into a high valuation over time. Quality rarely comes cheap.
Makes sense. So if it's going to grow into that valuation, what drives the growth from here? Is it just waiting for the housing market to boom again? Or is there more to it?
That's a key insight. Future growth isn't really about waiting for housing cycles or GDP surges. The main engine is continued market share gains.
Grabbing more of the pie?
Exactly, especially share of wallet within that core professional painter segment. Their whole strategy is geared towards deepening the relationship with each pro.
Wow.
By offering that unmatched suite of products, the expert service, but also adding things like innovative digital tools. Their Color Snap Visualizer app gets like 22 million uses a year.
Wow.
And having those dedicated sales reps who aren't just order takers, they act more like business consultants for the contractors. Plus, they're pushing into adjacent pro markets like coatings for factories or commercial building repainting that are growing faster, maybe high single digits.
So it's more about execution within their niche than just riding broad economic waves.
That seems to be the focus, yes. Winning more business from existing and new pro customers.
Okay.
Yeah.
Sounds incredibly solid. But every investment has risks. If you're thinking really long term, what could permanently damage this business?
Yeah.
What are the nightmare scenarios?
Yeah, you always have to consider that. Based on the sources, 3 main permanent impairment risks stand out. Number 1, and probably the biggest long-term threat, disruption of that pro-focused distribution model.
How could that happen? Amazon for paint?
Sort of. Imagine a competitor, maybe digitally native, asset light, using really sophisticated logistics to deliver paint directly to job sites, bypassing the need for stores altogether. And what if they could use AI to replicate the expert advice you get in the stores? If they could do all that and offer lower prices because they don't have the massive fixed costs of 5,000 stores, then suddenly that huge store network could become a liability, not an asset.
That's a scary thought for them.
Yeah.
Okay, risk number 2.
Catastrophic brand or reputational damage. Their brand is built on trust, especially with pros. Imagine a massive, widespread product failure. Or maybe major litigation around environmental issues or health concerns related to their chemicals. That's always a background risk for chemical companies. If something like that happened, it could shatter the trust, collapse their pricing power. That would be devastating.
Okay. And the third big risk.
The third one is a competitor actually succeeding in replicating their model. building a competing national network focused on pros.
Has anyone tried?
People have tried, but it's incredibly hard and expensive, which is why the moat is so strong. But you can't rule it out forever. If a really determined, well-funded competitor managed to build a comparable network,
then you'd get intense price wars.
Exactly. Serious price competition, margin pressure across the board. It would fundamentally change the industry dynamics.
Okay, those are some serious potential threats, even if they seem distant now. So let's try to bring it all together with some second-level thinking. What's the market maybe missing or underappreciating about Sherwin-Williams right now?
Well, the general market consensus, the first level thinking, seems to be, great company, best in class, but facing some cyclical headwinds in housing and industry. Valuation looks fair, maybe a bit stretched, limited upside in the near term.
Sounds reasonable enough. What's the deeper take?
The deeper second level analysis suggests the market might be fundamentally misinterpreting the role of those cyclical headwinds.
Oh, so?
It underestimates how economic slowdowns are actually the main way Sherwin-Williams widens its moat.
Back to the countercyclical investment.
Exactly. A slowdown hurts everyone's earnings temporarily, sure, but Sherwin-Williams, with its financial strength and disciplined approach, uses that exact moment to invest aggressively in new stores, more sales reps, while weaker competitors have to cut back.
So they gain ground during the tough times.
Precisely. They emerge from every downturn stronger, with a larger market share, with a wider moat than before. The very cyclicality that the market seems to fear and maybe penalizes the stock for is actually the engine of the company's resilience, its anti-fragility, if you will.
So the market sees cyclical risk, but misses the compounding competitive benefit Sherwin-Williams gets from that same cycle.
That seems to be the crux of the second-level insight. They're pricing in the short-term pain without fully appreciating the long-term gain that SHW consistently extracts from it.
Wow. What a fantastic picture we've painted today. We've really explored that deep economic moat, the alignment with the huge shift to do it for me, the exceptional financial quality, and that really disciplined management culture.
Right. And it makes you think, doesn't it? Considering this unique ability Sherwin-Williams has to actually use economic downturns to get stronger in the long run. What does that tell you, really, about the true nature of risk versus opportunity, especially in industries that look cyclical on the surface?
That's a great question to ponder. It's fascinating how sometimes what looks like a weakness, or at least a challenge, for a truly well-run business, can actually be turned into a source of enduring strain, a way to pull further ahead. Hopefully this deep dive gives you some food for thought for your own explorations into what makes a business truly built to last.